Right now, the bond market is pricing in something that almost nobody was expecting a year ago: a Federal Reserve interest rate hike, not a cut, as soon as January 2027. Read that again. For the better part of 2 years, Wall Street was betting the Fed would be slashing rates by now. Goldman Sachs said it, the bond market said it. It's actually part of the reason Trump reportedly wanted a new Fed chair in the first place, someone who'd bring rates down. And instead, the futures market is now assigning odds as high as 45 to 70% that the next move is up, not down. That is the opposite of the plan. So in this video, I want to walk you through what's actually happening at the Fed right now, why the whole rates are coming down story quietly flipped upside down, and what it means for your money if you're sitting on cash, bonds, or a retirement account you're hoping will still be there in 10 years. Hi, my name is Jeff Reed. Hope you're doing well today. Stick around for the finance. Stay for the part where I explain why raising rates right now might actually be the least bad option the Fed has left, which is a genuinely strange sentence to say out loud. Okay, so let's start with the basics, because this stuff only sounds complicated. It isn't. The Federal Reserve sets something called the federal funds rate. Think of it as the base interest rate for the entire economy, the rate that every mortgage, every car loan, every credit card, every business loan gets built on top of. Right now, that rate sits at 3.5 to 3.75%, and the Fed just voted, unanimously, to hold it there at their June meeting. Their next decision comes at the end of this month. Now, a bond is basically an IOU. When the US government needs money, it sells bonds, pieces of paper that say, lend me money now and I'll pay you back later with interest. The interest rate on those bonds is called the yield. And here's the thing about yields: they move on their own, based on supply and demand. Kind of like a garage sale. If everybody wants to buy your stuff, you don't have to drop the price. But if buyers start walking away, you either lower the price or you sweeten the deal. In bond terms, that means offering a higher yield. So when yields start climbing on their own, it's usually the market telling you something the headlines haven't caught up to yet. So why, after 2 years of the Fed is definitely cutting, is the conversation suddenly about hiking? There are three real reasons, and each one builds on the last. Reason 1. Inflation didn't go away. It changed shape. Energy costs, largely tied to the Middle East conflict, have been feeding straight into the supply chain. And when input costs go up, prices don't quietly fall back down just because a central bank wants them to. Fed officials who were dovish a year ago are now openly changing their tune. Chris Waller, one of the first governors to vote for rate cuts, recently said, quote, "I can no longer rule out rate hikes further down the road if inflation does not abate soon." That's not a hawk talking. That's someone who wanted to cut, admitting the data won't let him. Reason 2, and this is the one people miss: some of the biggest foreign buyers of US debt are pulling back. For decades, the world just bought our bonds. It was the safest trade on the planet. But when major foreign holders start selling instead of buying, the US government has to offer higher yields to attract anybody else willing to hold that debt. Less demand, higher price to compensate. That's not a policy choice. That's basic math showing up in the real world. Reason 3, and this is the uncomfortable one: the US government's math has no clean exit. We're carrying roughly $39 trillion in debt. Every one of those trillions eventually needs to be refinanced at whatever the going interest rate is. If yields stay elevated or go higher, the interest payments alone start eating an enormous share of the federal budget. And here's the trap: if the Fed tries to cut rates to relieve that pressure while inflation is still running hot, bond investors could interpret that as they care more about propping up the economy than protecting the value of my money. And when bond investors think that, they sell, which pushes yields up anyway. So cutting rates to fix the problem can paradoxically make the problem worse. That's the box the Fed is boxed into right now. Real quick, before I keep going, because this stuff has real consequences for anyone with savings sitting in cash or bonds, I put together a free retirement protection guide that walks through exactly how shifts like this typically affect ordinary retirement accounts, and some of the ways people are positioning around it. It's free. Link is below this video, or you can just scan the QR code on screen right now. All right, back to it. So let's zoom out, because this isn't the first time the US has been in a corner like this. Go back to the 1970s. Inflation was running hot. The Fed under Arthur Burns kept flip-flopping between fighting inflation and propping up growth, and it took Paul Volcker slamming rates up into the high teens to finally break the cycle. at the cost of a brutal recession. Nobody wants a repeat of that. But the underlying mechanics rhyme. When inflation gets ahead of the central bank and the bond market loses patience, rates eventually have to go up, whether policymakers want that outcome or not. And here's what's genuinely fascinating. The people closest to the money seem to already be positioning for exactly this. Look at what central banks around the world have been doing. In the first quarter of this year alone, central banks bought 244 tons of gold, a 17% jump from the quarter before. Poland has been one of the most aggressive buyers, adding over 60 tons this year. China has now bought gold for 20 straight months. Uzbekistan, Kazakhstan, Singapore, all adding to their reserves. Meanwhile, gold itself has climbed above $4,100 an ounce, up more than 20% over the past year, even after pulling back slightly on Middle East headlines. Silver sitting above $60. These aren't retail investors panic buying, these are national governments, quietly and deliberately shifting away from paper assets and into something that doesn't carry anyone else's promise attached to it. There's also a bigger structural idea floating around Washington that almost nobody's talking about outside of policy circles. The US still values its official gold reserves at an outdated price of $42 an ounce, a number from another era, sitting on the books while the actual market price sits over $4,000. If the Treasury simply updated that number to reflect reality, more than $1 trillion in value could appear on the government's balance sheet overnight without issuing a single new bond. The Fed has actually published research exploring this exact idea. It's the kind of move that sounds abstract until you realize it's one more sign that the people managing the system are thinking hard about how to reposition America's own balance sheet for a world where debt costs more and gold matters more. So, why does any of this actually matter to you? Sitting at home, not running a hedge fund, not making Fed policy. Because higher for longer rates, or a surprise hike, don't stay contained to Wall Street trading desks. They show up in your mortgage rate if you're refinancing. They show up in what your bonds are worth if you're holding them and rates move against you. And they show up in how your retirement savings are actually allocated, especially if you haven't looked at that allocation in a few years and it's still built for the rates are coming down story that increasingly isn't the story anymore. Now look, I'm not here to tell you the sky is falling or that you have some ticking countdown clock on your savings. That's not how this works. And honestly, anyone selling you that kind of panic is selling you something else too. What I will say is this. The people who run the system, central banks, treasury officials, the Fed itself, are visibly, publicly positioning for a world where paper debt gets more expensive and hard assets get more valuable. That's not a prediction. That's what the data, the buying patterns, and the Fed's own research are already showing you in plain sight. The question isn't whether something dramatic is guaranteed to happen. The question is whether you're paying attention to what the people closest to the information are actually doing with their own money. So let me tie this all together. The market went from betting on Fed rate cuts to pricing in real odds of a hike because inflation stuck around. Foreign buyers stepped back from US debt, and the debt math itself leaves the Fed with no easy exit. History tells us these standoffs between inflation and rate policy don't resolve quietly. They resolve with real moves in real numbers, the kind that show up in your monthly statements, whether you were watching or not. And in the meantime, central banks worldwide are already voting with their own reserves, buying gold at a pace we haven't seen in years. If you want to understand exactly how a shift like this could touch your own retirement savings and what people with $100,000 or more in a retirement account are doing about it, we host a free one-on-one educational web conference where we walk through it in plain English. No pressure, no sales pitch, just the numbers laid out clearly. It's genuinely worth 20 minutes of your time if you've got real money sitting in an IRA or 401k right now. Before you go, grab that free retirement protection guide I mentioned earlier. Links below, or scan the QR code on your screen. It walks through this exact scenario in more detail, and it costs you nothing but a few minutes to read. I hope you have a wonderful rest of your day, and I'll see you in the next one.